So in this lecture, I'm going to quickly walk you through how to calculate sales tax payable and bonuses when the calculation is a bit more complicated. In most textbooks, they have very straightforward ways of doing this, and I'm not going to revisit all the different ways here. Rather, I'm going to just provide two brief examples where the initial calculation might be a little more complicated. It's not too hard, but with a little algebra, you can arrive at the correct answer. And so first talking about sales tax payable, it's important to note that each state and municipality does charge sales tax. Retail firms collect this tax on behalf of the state or municipality, and then they remit the payment, usually on a quarterly basis. And so it's collected from a consumer, but it's really the state taxing the consumer rather than the retail firm paying or being taxed. It's the consumer who's being taxed. And so basically the idea here is because they're just a middle person, they're not creating revenue. And so the retail firm does not record any revenue due to the sales tax. Rather, they're just collecting and remitting. And so if you could imagine, they have a payable and then they have a cash payment and it goes away. And so, of course, it is revenue for the state or the municipality. So in an example here, which does happen a lot of times, where there's a payment or a sale that's recorded and the sales tax is included. This is a lot of times with vendors that deal a lot with cash. They don't want to worry about pennies, and so they'll just say, all right, the sales price includes sale tax, and then they settle up with the state or local entity on a quarterly basis. And so let's record this sale, assuming that the sales tax rate is 5%. And so sort of setting this up algebraically, we know that the $10,000 is equal to the sale plus the sales tax. And that sales tax, of course, is a percentage of the sale. So when we apply that, we know that 10,000 then must equal 1.05 times the sale. And so then we divide both sides by 1.05. We can see that the sales revenue portion of the sale was $9,523. Which means the sales tax must have been $476. And so the journal entry for the cash payment received of $10,000, we have sales revenue $9,523 and sales tax payable for the difference of $476. The second thing we're going to work on here is how to handle bonuses. Again, a lot of times employees can receive a bonus based on performance, company income, those other things. Of course, sometimes the bonus can be very complex. As an accounting person, it's just important to read the agreement to make sure, first of all, that the executive is paid correctly, but also make sure that the accounting is done correctly to record the expense related to it. And so we have a company that has $145,000 in net income. Employees are paid bonuses of 5% of the after bonus net income. And so now we got to use a little algebra to figure out how much the bonus is going to be. So again, the bonus is 5% times the after bonus net income. So we multiply 5% through, and we can see 7,250 minus 0.05 times the bonus. We bring the 0.05 over, and so 1.05 times the bonus equals 7,250. Divide both sides by 1.05, and we can see that the bonus then must be $6,905.